It's often easy for private investors to forget how much easier it's become for them to trade. Back in the day, in order for me to get any leverage, back in 1990, we're talking about when, having left school, I was more actively trading. What I had to do was trade options because it gave me leverage, and that meant I was trading calls, puts, and predominantly calls and in the money calls, because the spreads were so wide that I couldn't afford to do any clever tactics like condors and butterflies and all the rest of it. And whenever I tried, the costs were just too extortionate. So I would do, I mean, you can look at Apple at 336. I would probably have bought something like a 330 call at the time, and not near the near expiry ones. I wanted them in the money because I wanted to take slightly less risk, and I didn't want the premium to expire valueless and me end up with nothing to show for it. So like I say, slightly in the money and mid-month to expiry. Anyway, all of this stuff, and you look at this screen, quickly shows you what a pain in order to get some leverage, because all I was looking for was that if the underlying price of Apple, let's say I thought on my analysis it was going to go from 336 to I don't know, 350, then I know that that 330 with the bid at, well, let's call it the offered at 10, costing me 340. So if it went to 350, I know I'd got another 10 at least to make on it, on the premium that I'd be paying, or rather the margin that I'd be paying would be negligible. So I know I'd almost not quite double my money, but make a 50% return if I got the analysis correct, etc., etc. But you can see just from looking at this screen that it is not necessarily a particularly easy thing to do. If we do want to simplify things, we can, but it still makes, it's not a way to spend a life, just sort of gazing at this all the time, let alone if one were to look into a whole host of other things and term structures of God knows. I would like I said, I'd keep things simple most of the time. Okay, you could simplify it by just removing the irrelevance and just focus on, say, calls, and then just looking at the what are we now, June. So I would have focused certainly not on the June expiries, not even probably on the July ones, probably on the August ones. And for those who understand options, that's a lot to do with how the impact of theta, or the time value, depreciates. And I knew the way I did my analysis, it would take time for the price to get to, let's say, from 336 to 350. And therefore, I knew I might have to wait. I didn't want to predict too many things, so I knew I need to get mid-month, something like a 21 August option. Why did I want an 18th September one? Well, because if it did move to 350, then the impact on that price would be negligible, because it's so too far out, and it was always this balancing act. But you can see the maths that's going on in the head in terms of calculations, let alone the impact of volatility. Again, mid-month was a good balance because a little move in volatility didn't impact the prices as much as a large move, and I didn't want to be trying to juggle too many things. Now, of course, you've got CFDs. It's easy. You've got the leverage that you want. But again, doesn't mean you should use it. What I'm saying is it's a lot easier. I don't want to sound like a person who's saying back in the day, in my day, son. But it is like that. You've got it a lot easier. I'm not trying to put people off options trading. I'm just saying it's a lot easier than using options in order to get returns. Don't get me wrong. I'm still fond of options. And the great thing is they're available on so many different securities as well. So it makes life very easy, and you can just switch around, lots to do on these things. Anyway, I just wanted to share that with you, and some I won't say reminiscences of an options operator. But it is easier now with CFDs to trade, and easier also means we've got to be more aware of risk as well. Anyway, enjoy.